84%. That's where silver is sitting right now as of March 7, 2026. 84% of its 30-day high. And if that number means nothing to you yet, it will by the end of this video. Because that gap, that 16% discount from a record all-time high that was set just 36 days ago, is sitting right on top of the single most explosive delivery situation the COMEX has ever recorded in modern history. 52.63 million ounces of silver have been demanded for physical delivery in the March contract cycle. 52 million ounces. And the registered inventory that's supposed to back all of that? 86.13 million ounces. That means more than 60% of everything available for delivery has already been claimed in a single month. And today specifically, we are deep inside that delivery window, watching in real time as one of the most important physical stress tests in the silver market's history plays out. Most people watching Netflix and scrolling their phones right now have absolutely no idea this is happening. By the end of this video, you will understand exactly what's going on, why it matters, and what it means for you personally. Stay with me. Let me give you the full picture first, because context here is everything. Silver hit an all-time nominal high of $121.62 per ounce on January 29, 2026. That was the peak, the absolute top. And within 30 hours, it had crashed to an intraday low of just under $75, a 47% collapse in less than 2 days. The headlines called it a speculative blow-off. The mainstream financial media said the bubble had popped, and a lot of people panic sold. Then something strange happened. Silver didn't die. It recovered. Steadily, methodically, it clawed its way back up through the 70s, through the 80s, briefly touching 97 in early March before pulling back to where it is right now, around $83 to $84 per ounce. The mainstream press is still calling this a correction. They're looking at the price and seeing weakness. But what they're not looking at is the delivery data. And that delivery data is telling a completely different story, one that has never been told quite like this before in the history of this market. Here's what you need to understand about the COMEX, because I think a lot of people have a fundamental misunderstanding of how it works. The COMEX is the commodity exchange in New York, part of CME Group, and it's where silver futures contracts are traded. A futures contract represents 5,000 ounces of silver. When traders buy and sell these contracts, the vast majority, historically more than 95%, are settled in cash or rolled forward. Nobody actually picks up the silver. It's like a casino where most players never touch real chips. The system runs on the assumption that very few people will ever demand the actual physical metal. For decades, that assumption held. It was the foundation of the entire pricing mechanism. But what we've been watching in 2026 is that assumption starting to crack. And the COMEX delivery data from this March cycle is the clearest evidence yet that something fundamental has changed. Quick note for those who aren't subscribed yet. My analytics show about 3 out of 4 people watching right now haven't hit that subscribe button. If this kind of deep dive analysis is cutting through the noise for you, go ahead and subscribe. That's how I know who the committed community is, and it helps the algorithm show this to more people who genuinely need to see it. Now back to the data, because this is where it gets serious. The February 2026 COMEX delivery month was the highest February delivery volume in modern COMEX history. 5,036 contracts, representing 25.18 million ounces. Think about that. That was February, which is historically a minor, low-volume delivery month. The kind of month where you'd expect maybe a few hundred contracts. 5,000 contracts. Then, March's first notice day on February 27th came in with 10,526 contracts standing for delivery. That's 52.63 million ounces in a single month's demand. And here's the number that makes your stomach drop. In the 60 days between January and February 2026, 74.38 million ounces of silver were delivered or requested through COMEX. 74 million ounces in 60 days. For comparison, the annual mine production of the entire United States is around 33 million ounces a year. We're talking about consuming more than twice the U.S. annual mine output in 60 days through a single exchange. This isn't normal. This isn't remotely normal. And I'm not asking you to trust me on that. You can verify every single one of these numbers at the CME Group's own delivery reports, cmegroup.com, their metals issues and stops month-to-date report. These are their numbers, not mine. Now I want to show you something that puts this all in historical context, because once you see the pattern, you can't unsee it. Throughout history, whenever physical commodities started being demanded out of the paper system faster than the paper system could replenish them, there was always a reckoning. Always. Let me take you back to 1980. A pair of Texas oil billionaires, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, started accumulating physical silver in the early 1970s. By January of 1980, silver had run from about $6 an ounce to $49.45. They were taking physical delivery, removing silver from the system, and the paper shorts were getting obliterated. Sound familiar? The COMEX responded on January 21, 1980, by implementing what they called Silver Rule 7, which effectively restricted buying silver on margin. They changed the rules mid-game. Silver collapsed within weeks. March 27, 1980, Silver Thursday. The Hunts missed a margin call, and the price plunged to $10.80. The exchange survived. The Hunts went bankrupt. Lesson learned. When physical delivery pressure threatens the paper system, the exchange changes the rules. That was pattern 1. Remember it. Pattern 2 came in 2011. Silver ran from about $17 in late 2010 to $47.94 in April 2011. The CME Group raised margin requirements 5 times in 9 trading days. 5 times. Each time they raised margins, leveraged longs got forced out of their positions, and the price dropped. Silver fell from $48 to $32 in a matter of weeks. Again, when the paper market gets stressed, the exchange reaches for the margin lever. Pattern 2 confirmed. And now pattern 3, January 2026. Silver runs from $70 to $121.62 in a single month, the largest monthly gain in silver's modern history. What happened? The CME Group raised margins. The price crashed 47% in 30 hours. But here is where 2026 is fundamentally different from 1980 and 2011. In both of those historical events, the pullback in price also led to a pullback in physical delivery pressure. Traders backed off. The system stabilized. In 2026, the price crashed 47%, and the physical delivery demand accelerated. Not slowed. Accelerated. The February delivery numbers came in as the highest February on record. The March open interest came in with over 10,000 contracts demanding delivery. A lower price is supposed to reduce demand in physical markets. That's basic economics. Instead, it increased, which tells you the buyers aren't speculators looking for a quick profit. They're buyers who need the metal. Industrial users, sovereign wealth funds, institutions that looked at the price drop and said, "This is my chance to get it cheaper." We are in uncharted territory. No historical pattern quite maps onto this. Let me walk you through the inventory collapse, because this is the smoking gun. In October of 2025, COMEX registered silver inventory, that's the metal specifically designated as available for delivery, sat at approximately 167 million ounces. By the time February 2026 ended, it had fallen to 86.13 million ounces. That is a decline of nearly 81 million ounces in just 4 months, a 48% drawdown. And the rate of drain during January and February was running at roughly 785,000 ounces per day. Every single day. Think about that for a second. Every 24 hours, nearly 800,000 ounces of silver was leaving COMEX vaults. That's like draining an Olympic swimming pool of silver, every single day, while simultaneously trying to convince the market everything is fine. But it gets worse. Go back further. In April of 2020, COMEX registered inventory was 240 million ounces. Today it's 86 million. That's a 64.1% decline over 6 years. And it didn't decline gradually. It accelerated dramatically in the back half of 2025 and into 2026. Now here's the part where the global picture becomes absolutely critical. Because COMEX doesn't exist in isolation, the other major trading hub for silver is the Shanghai Gold Exchange in China. And on January 1st, 2026, the Chinese government flipped a switch that sent shockwaves through the entire global silver supply chain, a move that most Western investors still don't fully understand. China implemented strict export controls on refined silver. Not a full ban technically, but practically, for most exporters, effectively a ban. Under the new licensing framework, only companies producing at least 80 tons of silver annually and maintaining $30 million in credit lines can even apply for an export license. That requirement eliminates hundreds of small and mid-sized Chinese refiners who have been quietly feeding the global industrial silver supply for years. And here's why this matters so much. China controls between 60 and 70% of the world's refined silver supply. When they turned the tap down on January 1st, they didn't just tighten the market. They severed the traditional arbitrage route that had been the safety valve keeping COMEX and London inventory from collapsing. Shanghai inventories hit their lowest level since 2015 in mid-February, and at various points in January, Shanghai physical silver was trading at a premium of $10 to $13 per ounce over COMEX futures. In a normal market, that spread would attract arbitrageurs who'd buy cheap in New York and ship to Shanghai. But you can't ship metal you don't have. You can't arbitrage a physical shortage with paper promises. Stick with me because this next part is critical. I want to show you the exact numbers on the Shanghai COMEX divergence, because this divergence is telling you something the paper price simply cannot. On Thursday, January 22nd, Shanghai was trading at $104, while COMEX sat at $94. The next day, Shanghai hit $112. COMEX was at $102. By Monday, January 26th, Shanghai was at $123. COMEX futures had to chase it to $117. Shanghai was leading. COMEX was following. For decades, it was the other way around. New York set the price, and the world followed. Now the market where physical metal is actually changing hands is setting the price, and the paper exchange is playing catch-up. That is a fundamental, tectonic shift in how this market works. And it didn't happen because of speculation. It happened because of a supply reality that paper contracts simply cannot paper over forever. Now let me ask you something. You have two prices in front of you. Screen says one thing, physical market says another, $8 to $13 higher. One of them reflects the reality of actual metal you can touch and deliver. The other reflects a promise that someone will deliver metal someday, maybe, probably, unless the rules change or the margin gets hiked or the contract gets cash settled. If you needed silver for your solar panel factory, for your semiconductor fab line, for your medical device production, which price would you trust? The answer is obvious. And that's exactly what Samsung, Tesla, and major tech manufacturers have been doing. Samsung C&T finalized a deal where it paid a prepayment to Canada's Silver Storm Mining, locking in exclusive rights to 100% of the La Paria mine's silver output for 2 years. Not buying futures, not using COMEX, locking up a mine directly. That's what it looks like when companies stop trusting the paper market to deliver physical metal. They go around it entirely. Let me break down the math of the current March crisis in the plainest possible terms, because I think it gets buried in technical language and people's eyes glaze over. Stay with me here. At the start of the March delivery cycle, on February 27th, 10,526 contracts stood for delivery. That's 52.63 million ounces of silver physically demanded. Registered inventory was 86.13 million ounces. So immediately, on day one of the March delivery window, over 60% of all available registered inventory was claimed. Now you also had the hangover from January and February, 74.38 million ounces already delivered in those 2 months. Add those deliveries together, and you start to see a picture where the math simply doesn't work for much longer. The buffer between what's being demanded and what's available is the thinnest it's been in the history of the exchange. The Financial Content Report for March 4th described the buffer as having reached its thinnest level in exchange history. Those aren't my words. That's a direct summary from market analysts watching COMEX data in real time. Now here's what makes this truly alarming from a structural standpoint. In every prior squeeze scenario, the exchange had a clear release valve, the eligible inventory. Eligible silver is metal stored in COMEX-approved vaults that hasn't been formally designated as available for delivery yet. The owners have to consent to reclassify it from eligible to registered. In theory, it's a buffer. In practice, the eligible owners are looking at the same inventory charts you are. They know what's happening, and they are not converting their eligible silver to registered at these prices. They're holding. Why would you voluntarily push your silver into a delivery queue at $83 when you watched it trade at $121 6 weeks ago? You wouldn't. You'd wait. And that's exactly what's happening. The conversion rate from eligible to registered has slowed dramatically, even as delivery demand has exploded. The people who own eligible silver have made a rational decision that is now turning into a systemic problem for everyone who relies on COMEX to function. And this is where I want to name the institutional elephant in the room, JP Morgan. JP Morgan holds the largest known cache of registered COMEX silver inventory. At the peak, it was well over 100 million ounces. As of the most recent data, their registered pile has been cut roughly in half, down to approximately 16.8 million ounces. The largest commercial bank in America, the same institution that has been the subject of federal investigations for silver market manipulation going back years, multiple traders convicted and sentenced, is sitting on 16.8 million ounces of registered COMEX silver, while the market demands 52 million ounces in a single month. JP Morgan's own analysis, by the way, came out during the January volatility period and said, and I'm paraphrasing their public release here, that we remain firmly bullishly convicted in gold over the medium term, with a 2026 forecast of $6,300 per ounce. JP Morgan, the entity with one of the largest precious metals desks on Earth, is publicly bullish on gold and silver even after the crash. Think about what they know that they're not publishing. Let me zoom out and show you the 5-year arc of this story, because nothing happens in isolation. COMEX total silver deliveries doubled from 203 million ounces in 2024 to 474 million ounces in 2025. Every single month of 2025 had higher deliveries than the same month in 2024. Every month, without exception. That's not a monthly anomaly, that's a trend. A structural, accelerating trend of people taking physical delivery out of the COMEX system and not putting it back. Pair that with the global demand picture. The Silver Institute estimated that in 2025, global silver demand reached 1.24 billion ounces. Total supply, mining plus recycling, came to roughly 1.01 billion ounces. That's a deficit of 230 million ounces in a single year. 230 million ounces. That's roughly equivalent to the entire annual output of Mexico, the world's largest silver-producing country, just vanishing into the demand hole. And this wasn't a one-year event. Silver has run a supply deficit for 5 consecutive years. 5 years of consuming more than was produced. And the inventories that were built up in prior surplus years have been getting drawn down steadily, year after year, until we get to where we are now. With COMEX registered stocks at their lowest level in years, and the March delivery spike testing the system harder than it's ever been tested. Now let me ask you a question I want you to sit with for a moment. If you ran a futures exchange, and you saw that 60% of your registered inventory was being claimed in a single delivery cycle, what would you do? If you look at the historical playbook, 1980, Silver Rule 7, 2011, 5 margin hikes in 9 days. In 2026, the CME Group has already reached for that lever. They introduced cash-settled alternatives to physical delivery. They increased margin requirements. They've been managing this pressure with every tool they have. And so far, they've avoided a formal default. But there's a limit to what financial engineering can do when the physical reality diverges far enough from the paper price. You can change the rules. You can force cash settlement. You can raise margins so high that nobody can afford to hold a position. But you cannot conjure physical silver out of thin air. And the industrial users who need silver to make solar panels, electric vehicles, semiconductors, and medical devices, they cannot accept cash settlement. They need the metal. That's the wall this market is approaching, and the March 2026 delivery cycle is the most visible stress test of that wall so far. So what does all of this mean for you specifically? I want to make this practical. First, and I have to say this clearly, nothing in this video is financial advice. I'm not a registered investment advisor. This is analysis and education only. You make your own decisions. With that said, let me give you the 5 things I think matter most right now based on everything we've just walked through. 1. The price at $83 to $84 today is not evidence that the crisis is over. It's evidence that the paper market and the physical market are temporarily back in the same zip code after the January spike. The underlying structural forces, the inventory drain, the China export controls, the delivery demand acceleration, have not reversed. They've continued. A lower price does not mean a solved problem. 2. If you are holding silver, the question isn't whether you bought it right, but whether the reasons you bought it have changed. The supply deficit hasn't changed. The China export controls haven't changed. The COMEX registered inventory collapse hasn't changed. The only thing that changed is the price temporarily came down. 3. Watch the COMEX registered inventory numbers like a hawk over the coming weeks. If registered inventory drops below 70 million ounces while March deliveries are still being processed, you are watching something historic. The CME publishes these numbers daily. You can find them at cmegroup.com under delivery reports. 4. The paper-to-physical spread, the premium that physical silver commands over the futures price, is your real-time signal of how stressed the delivery system actually is. When that premium blows out, it means people are paying up to get real metal because they don't trust the paper promise. Right now, the Shanghai premium over COMEX is running at $8 to $13 per ounce. That is not a healthy, functioning, arbitrage-efficient market. That is a market showing physical stress. 5. Watch the May contract open interest and delivery demand. If the March stress cascades into May, as several analysts have warned it could, you are watching a sequence that could produce the most dramatic silver market event in 45 years. Here's the timeline that history suggests we should be watching. In the 1980 Hunt Brothers scenario, from the time delivery pressure first became visible to the ultimate price peak was roughly 8 to 10 months. In 2011, the run from the initial supply tightening signals to the April peak was about 6 months. In 2026, silver's bull market began its acceleration in roughly mid-2025. The first institutional signals of physical stress, the early COMEX drawdowns, the January delivery data, became visible in late 2025. The all-time high hit January 29th. We are now 5 weeks off that high, sitting at 84% of the peak, with the March delivery cycle unfolding in real time. If this follows a pattern at all similar to prior cycles, we are not looking at the end of a move. We are potentially looking at a mid-cycle correction before the next leg. The Fibonacci extension target that technical analysts are watching for a confirmed breakout above the cup and handle formation is $136 per ounce. That's 62% above today's price. ANZ Bank has gold at $5,800 in Q2 2026. JP Morgan has gold at $6,300 for the year. At a gold-silver ratio of 50, where it is right now, that's silver at $116 to $126. First Majestic Silver CEO Keith Neumeyer, who called triple-digit silver years before anyone believed him, recently said in an interview with Kitco, "We've created a new pricing paradigm. We are not going back to the old pricing that we're all used to over the past 20 or 30 years." Those are not the words of someone who thinks the story is over. Now let me bring this full circle, because I started this video with a number, 84% of the 30-day high. That number is sitting right on top of the most intense COMEX delivery cycle in modern exchange history. And the pattern is almost insultingly clear in hindsight. 52 million ounces of silver claimed for delivery against 86 million available. China has cut off the traditional arbitrage route by implementing export controls on 60 to 70% of global refined silver supply. COMEX registered inventory has fallen 64% since April 2020. The Shanghai premium over New York prices is $8 to $13. Samsung is locking up mine output directly. Tesla is securing supply through direct agreements. Industrial demand cannot be switched off. Solar, EVs, semiconductors, medical devices, none of those industries have a substitute for silver, and none of them can accept a cash-settled futures contract in lieu of the physical metal they need to keep their production lines running. The supply deficit hit 230 million ounces last year alone. The paper-to-physical ratio sits at approximately 356 paper ounces for every single real ounce available for delivery. 356 to 1. The people before us who went through 1980 didn't see it coming until Silver Thursday. The people in 2011 didn't see it coming until the margin hikes forced them out. The signs were there both times. They are visible now in 2026, documented in official CME filings, Silver Institute reports, and exchange data that anyone can access. The only question, and this is always the only question in markets, is whether you'll be positioned correctly before the next leg, or whether you'll be watching it on the news afterward, wondering why nobody told you. Drop a comment below and tell me this. What do you think matters more right now? The paper price of silver or the physical delivery data? I read every single comment. Your perspective genuinely shapes what I cover next, and the debate in the comment section here is one of the most informed you'll find anywhere on this topic. If you want to go deeper on the mechanics of how COMEX delivery actually works, the next video covers exactly that. The difference between registered and eligible inventory, how force majeure clauses work, and what a cash settlement scenario would actually look like for silver holders. It's the video that explains what happens if the wall actually gets hit. I'll see you there.